You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today I've got Rich Howe. Rich is the founder of Stock Spinoff Investing. Rich, it's awesome to have you on. Thank you so much for coming on the podcast.
Yeah, thanks so much for having me on. This is fun. I was really looking forward to it.
Yep, Rich. We're gonna try and find out, how you do it. No pun intended when I said that, but yeah. So Rich, let's get started by talking a bit about your background. So, how did you really get into finance, and more importantly, how did you find your niche, which is really just spin-off investing?
Yeah, of course. So I grew up in Boston, and I still live in the Boston area. And both my parents were in the business. My dad worked in Boston. He was a large cap value portfolio manager, and my mom was actually a remote bond analyst. So she was a bond analyst for PIMCO. PIMCO is based on the West Coast. So she worked remote for them before that was really a thing. And so I don't know why I really gravitated towards investing, but I did. It was a way for me and my dad to connect. I have two older sisters. Neither one of them was particularly interested in investing, but I've always been interested from a young age. And so I did the thing like join investment clubs in high school, in college, and got internships in the business, whether it was at a brokerage firm or an asset management firm or equity research firm. And then I ended up getting an internship at Eaton Vance, which is a mutual fund company based out of Boston. I ended up getting a job there when I graduated, and I worked there for about 8 years. That was a great experience. They were recently acquired by Morgan Stanley, but they are, were public for a long time. They're primarily focused on large cap stocks and fixed income. So I spent a bunch of time there, about 8 years there. I got my CFA, got to learn a ton from a lot of really smart people. And then after that, I ended up switching careers a little bit and moved from public equity research to private equity research. So I switched jobs, went to Citi Private Bank, and was focused on finding good private equity opportunities. And after I was doing that, I love that. I love that business. I love the private equity world, but I really missed the public equity markets. And so while I was at Citi, I actually started an anonymous blog, Stock Spinoff Investing, to document my research process, try to find good ideas, try to find like-minded investors. And the reason why I focused on spinoffs is because it's an inefficient market, which we can talk about. I, don't think I'm necessarily the smartest person in the world. There are a lot of really smart people, looking at large cap, mega cap stocks, working harder than I am, smarter than I am. And so I want to find opportunities where there's kind of built-in alpha. And I think, not all spinoffs outperform by any means, but usually a lot of times you can find, spinoffs that are either overpriced or underpriced. So that's the area that I like to focus on. I also like to focus on like micro caps and small cap stocks for the same reason, just because I think that it's a little bit of a less efficient market and not as much eyeballs on it. And that produces the opportunity to potentially, find some lucrative investments.
Absolutely. And so, when you say spin-offs, so, do you focus only on spin-offs, or do you broadly focus on special situations?
I'd say special situations. So I initially was focused just on stock spinoffs, but so what I do is I run stockspinoffinvesting.com, which publishes a lot of free content. I have a spinoff calendar that helps people track what spinoffs are coming and which ones have been completed. And But what I do is I run a newsletter, a paid newsletter, and I basically cover the spinoff market. But I also, my bread and butter, what I'm trying to do is just find attractive stocks. Doesn't matter if it's a large cap, doesn't matter if it's not focused on spinoffs. I I just want stocks that go up because I'm investing my capital in those ideas. And so I tend to find most of my ideas in spinoffs or special situations, but occasionally I'll find just an idea that I think is compelling.
Uh-huh.
But yeah, it's primarily like, one idea that, you and I talked about before we went live was a company that's transitioned from a closed-end fund to a REIT. That's a special situation. It's not a spinoff, but it's an interesting idea. So things like that that are maybe under the radar of some other folks are areas that I like to look at.
Uh-huh. Yeah. Yep. And when it comes to sort of analyzing a spin-off or a special situation, how do you, one, do you have any resources, books, papers, etc., that you would recommend? And two, what is sort of your framework for identifying, what do you look for in order to identify a successful spin-off?
Yeah, so I'd say in terms of books, so part one of the question is, so You Can Be a Stock Market Genius by Joel Greenblatt is kind of what you definitely should read. So everybody's read that. It's my favorite book. It talks about the biggest chapter, talks about all sorts of special situations investing, but the biggest chapters on spinoffs, and it walks through some case studies, what you should look for, what you should avoid. And I think that's a great starting point. And then there's also, yeah, so I'd say that's a great starting point. I also have a resources page on my site that has a bunch of other papers and research that has been done on spinoffs. So check that out as well. In terms of what I look for, so I try to look at every spinoff that's coming to the market and do work ahead of time to see if it's potentially going to be attractive at the right price. The interesting thing about spinoffs is they file their Form 10s, what they're called. So it's kind of like the information statement. It's equivalent to an IPO's prospectus, where the IPO will say, or the company that's going public will say, hey, here's our revenue growth, here's our earnings, here's why you should buy us. A spinoff does the same thing. They file a document that's similar to the IPO prospectus that you can see all the pro forma financial trends going back several years. And so step one is looking through that just to understand the basics. Like, is this a company in secular growth? Is it in secular decline? Is it going to be highly levered? Who owns it? Is it going to be a large cap? Is it going to be a small cap? How incentivized is the management team? A lot of things like that. And so I try to do work on every spinoff that's coming to market to see if it potentially would be interesting at the right price. The problem is that oftentimes you'll do work on a spinoff and then it just starts trading too high and it never gets down to a level that you think is that interesting. So that's frustrating. Like Haleon, for instance, is a recent spinoff from GlaxoSmithKline. And it's a good business. It's a consumer business. It should trade at a higher multiple than Glaxo, and it does now, but it just doesn't look wildly compelling or asymmetric. And so, I did a good amount of work on that, and ultimately nothing came to fruition there. It didn't result in a recommendation, but that's what you got to do. You know it as well as I do. You got to turn over a bunch of rocks to see if there are good opportunities. And what I'm looking for is like the no-brainer ideas, the stocks that you see, the spinoffs or special situations where you see and you're like, oh my gosh, I got to drop everything and write this up and call management, call IR, because this idea looks like an absolute no-brainer. And they don't come around all that often, but sometimes they do. I'll give you just two examples. So one, this was before I launched my premium newsletter, but a company called Liberated Syndication. The ticker is LSYN. It's actually a podcast hosting company, so you might be familiar with it. But at the time, they were being spun off from another company, and it was a tiny company, like maybe a 20 million market cap. But the stock, you could see from its financials that it was trading, it had secular growth, it was growing 20% plus, and it was trading at like 3 times earnings. So that's pretty crazy. Like if a company is trading at 3 times earnings, that's a technology company that is not a fraud, then that's definitely a buy. And so the bet you had to make, and I did a bunch of research to make sure this was the case, was that the stock wasn't a fraud, and so I was able to invest, and that was really exciting. Another one that was pretty interesting recently was another microcap spinoff called BBX Capital. The ticker is BBXIA, and it just started trading at a 50% discount to the cash on its balance sheet. And it wasn't a biotech that was burning cash. It actually had operating businesses that were generating more cash. And so it was just mispriced, right? It was like a no-brainer. You drop everything and you dive into it. And so those are the situations that are so fun to find, but unfortunately, you gotta find it. You're gonna look through a lot of situations that aren't quite as attractive as that to find those more attractive setups.
So broadly, a lot of what goes on with microcaps is, you're able to find these opportunities where, you can, as you mentioned, find something that sells under cash, and, it's not a fraud, but also has some sort of secular growth tailwinds that, are going for it. So
Exactly.
yeah. And so why don't you start off by talking about one of your trade ideas or one of your investment ideas that you mentioned earlier, which is a closed-end fund that is transitioning into an REIT, a real estate investment trust. So that's NextPoint Diversified. So could you tell us a little bit about what's going on with NextPoint Diversified, why it's attractive as an investment opportunity, and what you see in it?
Of course, yeah. So NextPoint Diversified REIT. So NextPoint was basically it was a closed-end fund. So it was a big pile of cash that was raised years ago and was invested in a bunch of assets, mainly real estate assets, but some other securities, some CLOs, equity, debt, things like that. And as you're probably familiar, and many of your listeners are probably familiar, many closed-end funds trade at a discount to NAV because there's not that many people that are that interested in owning a closed-end fund. You have to pay a management fee. Why not just own an ETF, which are basically free at this point? You can get exposure to whatever, market you want. There's not much clarity oftentimes into what the closed-end fund owns or what the strategy is. And so there's not really a compelling case oftentimes to own a closed-end fund. But what made this situation pretty interesting is, first of all, it looked really cheap. It's trading and is still trading at about a 40% discount to net asset value. And then the other interesting thing is they announced 2 years ago that they're going to transition to a REIT. And so why is that interesting? There's a lot more natural investors that want to own REITs, than want to own closed-end funds. There are also passive investors. There are massive passive investors that are interested in yield and also interested in owning REITs. For example, there's a lot of ETFs that are just own REITs, and so for this company right now has about a 600 million market cap, and most 600 million market cap REITs have significant passive ownership in them. This company has no passive ownership because up until earlier this month, the stock was still a closed-end fund. And so that is the hard catalyst that the company announced 2 years ago that it was trying to pursue to transition from being a closed-end fund to a REIT. And it took a lot longer than they expected, but in early July, they officially got word from the SEC that they were approved to transition into being officially a REIT. And so the catalyst has kind of played out in a way. But the stock's up a little bit, but it's not up much. Interestingly, they are going to be hosting their first conference call to discuss their post-transition strategy. And I think it's going to be on Wednesday. Let's see. Today is it's going to be on Wednesday this week. So it might have already happened by the time our conversation goes live. But the really exciting thing is that this is a company that has a ton of cash on its balance sheet. It has at least 130 million of cash on its balance sheet. That's at least 20% of the market cap, 20% of NAV, not 20% of NAV, 20% of the market cap currently. And there's a lot of good things that could happen. There could be a massive buyback. The management team has historically done big buybacks. They could increase their dividend. They could spin off some of their underlying assets. So there's a lot of good things. We don't know exactly what's going to happen, but we know that the stock is undervalued unambiguously, and we know that we're going to get more granularity into what the actual strategy is. And then the last point that I think is interesting is the CEO is a guy named James Dondadero, who founded Highland Capital and is a smart investor. And he is a CEO, manages the business, and he's been just buying as much of the stock as he can, like hand over
Insider
fist.
buying, yeah.
He owns over 25% of shares, and like he's just every month he's coming into the market and buying more. And so clearly he sees something. He's a shrewd investor, and so that also gives me another measure of confidence that yes, this thing is very undervalued. He thinks it's undervalued, and he's the one that can do something to increase the return on his money. So a lot of things can go well with NextPoint, and currently it's just priced as a business that's maybe going out of business, kind of in secular decline.
Mm-hmm. So it's sort of priced as a business going in secular decline, but then you sort of see the opportunity where one, it trades below its NAV, and then when it becomes an REIT, you're going to start seeing flows come in. So you're going to see investors come, investors, ETFs, passive investors, ETFs, etc. come in, and then you're starting to see massive insider buying from the CEO. So broadly speaking, so in a way you sort of ticked all the factors that we were talking about earlier. You sort of see the valuation, you have a catalyst, and then you have flows, you have insider buying. So what could go wrong on this type of investment? What is the bear case? What are the risks associated with something like this?
Yeah, definitely. And actually, the transition to REIT has already happened. So it's actually officially already a REIT, which is interesting because typically REITs trade at a multiple of EBITDA or funds from operation. And historically, this company has not provided that information, but they're going to start providing it this week. This week. So it looks like a great setup. What could go wrong? So I think one thing that gives me confidence is that they have a lot of cash on their balance sheet. So I guess one area of pushback that I've gotten from investors is how confident are you that NAV is real, right? They're saying it's trading at a 40% discount, but a lot of the assets that they own are they're marking, they're real estate assets that they're marking. And so I think the biggest risk is likely that I'd say let's tackle that risk first. So the biggest risk maybe is that the NAV is wrong. I would say that in relation to that, one thing that gives me confidence is they just had a big realization. They sold a big position in MMG equity and debt, which was acquired by Amazon fairly recently and generated about 130 million of proceeds. So we know that the cash is there, right? So we know that at least 20% of the market cap is in cash. And then the other assets are in real estate. And we don't know exactly all the underlying granular details into how those assets are being valued. But we know that the majority of the exposure is in single and multifamily real estate, which has generally been a very good place to be, even in the current pullback. And then the other place that they've been is in the self-storage space. They also are developing a hotel in Dallas, Texas that looks like it's going to be monetized, or there's going to be some significant value add. They're partnering with a hotel to put the hotel in the top half of the condo building. And so it looks like there's a lot of positive developments, and it looks like from a macro perspective, they're in pretty good areas of the real estate subsector world. And then so it's not, I don't have independent valuations that suggest that the NAV is accurate, but I guess the cash, the areas of real estate that they are focused, and the fact that somebody who is a sophisticated investor, the CEO, he's buying in the open market. I wouldn't think he'd be buying if he didn't think that the assets were actually trading at a big discount to NAV. So that's what gives me comfort around NAV. And I think that's maybe one of the biggest risks. I think another risk is maybe we're in a recession right now, right? And maybe it's trading at a big 20%, maybe it's trading at a 40% discount to NAV, but maybe all that real estate is going to crash. And so it's really looking out a year or two, it's actually trading at the right valuation. and because all that real estate is overvalued right now.
Right.
And so, I think that is one way to think about it. I mean, I think one thing that gives me confidence, again, is all the cash that they have, that the areas of the market that they're in, the single and multifamily residential, the self-storage. I think those are areas that are kind of in secular growth right now. So that gives me a little bit of comfort. And then there's no leverage really on the portfolio. Like most REITs have a ton of leverage, and this company doesn't have any leverage. They're in a net cash position. So even if we go through a period of dislocation, they're going to be able to survive. And so maybe we don't make a massive return, but our downside is probably going to be capped or quite limited.
Yeah, so at the max, so you're sort of arguing, so even if the risks are right and the risk end up materializing, it's sort of trading at the valuation it would if those risks materialize. So for example, if we're in a recession and if the housing market slows down even further, we would end the REIT is sort of trading at the valuation that would, in a way, you don't really have much downside from here.
Exactly. That's that's well put.
Uh-huh. Yeah, so another idea that I wanted to discuss on the show was 3M. And so, we were talking a little bit about this before we started recording. So, but take it away, just put out the thesis.
Yeah. So usually I'm focused on, I cover the entire special situation and spinoff market. NXDT is under $1 billion market cap. I tend to focus on the smaller ideas because that's where you can find good opportunities usually. But every so often there's a large cap that sets up to be a really interesting situation. And so like I said, I'll make money anywhere. I don't care if it's large cap or small cap. I'm kind of indifferent to the market cap. But so the interesting thing with 3M, and this is going to be actionable when this goes live. So 3M right now is a big diversified company. It is, but the interesting news that's very interesting is that it's going to be breaking up. So it's going to be spinning off its healthcare division next year. It's going to be spinning off the more actionable, more interesting thing that it's going to be doing right now is it's going to be spinning off its food safety business. And so the way that it's doing this is it's merging its food safety business with a company called Neogen, ticker NEOG. And then 3M is basically distributing shares in the spinoff. Usually a parent will just say, hey, you own 1 share of 3M. Okay, I'm going to give you 1 share of this new company, whether or not you want it. The way that 3M is enacting its distribution here is through what's called a share exchange. And so what they're doing is they're saying, hey, if you own 3M stock, you can exchange that 3M stock for shares of this new company called Neogen, which is the new merged company.
Right.
But why would anybody want to do that, right? If you're a 3M shareholder, you own 3M because you like 3M. You're not choosing to invest in a food safety pure play. So why would you do it? So what 3M is doing is they're saying, hey, for every $100 of 3M stock that you trade in, I'm going to give you $107 of Neogen stock. So it's essentially a way to get a free 7% return. And this exchange offer is going to be taking place over the next month. And so that's interesting. But the next question is, well, if there's no free lunch, right? If there's a free 7% return, 3M stock's going to get bid up or something that can't be right. Well, that's the right takeaway. The caveat is that, so because this is basically kind of like a free lunch, a lot of investors are buying 3M stock. The stock's been very strong over the past week in anticipation of trying to capture this free 7% of Neogen shares. But the cool thing here for the small investors is that if you own what's called an odd lot, which means you own fewer than 100 shares of 3M, you won't get prorated. So there's going to be tons of demand because, again, this is a free 7%. Free lunch doesn't exist in the market. But 3M is saying if you own fewer than 100 shares, you're not going to get prorated. You're going to get 100% fully. You're going to be able to get the full 7% exchange of 3M shares into Neogen shares. And so the trade, and this isn't this isn't going to make you thousands of dollars, but it might make you $1,000, is you buy 99 shares of 3M, and then you put in to exchange those shares for Neogen. And so the exchange offer just got announced. The last day to participate is going to be the end of August. And then, so what you would do is you would buy 99 shares of 3M in your brokerage account. You call your broker, say, hey, listen, I want to exchange these shares for Neogen shares. I want to participate in the exchange offer. Because you own fewer than 99 shares, you're going to be able to do that without a pro rata, without getting cut back. And then once you receive your Neogen shares, you sell them in the open market and you lock in your 7% or so return, or your $1,000, or works out to about $1,000 profit. Now, this isn't a risk-free opportunity. There are several things that could go wrong. You could buy 3M stock and the stock could tank. So that's risk number one. That's unlikely to happen because everybody's buying 3M stock right now to participate in this exchange. So I've looked back at the last 15 of these transactions. They're similar transactions like this. They're usually 1 or 2 of these every year.
Mhm.
And I've seen typically the parent company, in this case 3M, appreciates between 3 and 4% over that month. So usually 3M goes up. 3M's already going up. So, but hey, it could be another pandemic or something that we're not thinking about where the entire market sells off. So that's one risk. The other risk is that once you exchange your shares, your 3M shares, yeah, you get 7% more value in Neogen shares, but then Neogen shares tank, and they tank before you're able to sell them. So that's a risk too. Historically, that hasn't happened. So again, I've looked back on about 15 of these, and historically, you do quite well if you buy the parent company and then exchange them into the spinoff shares and then sell them once you receive the shares of the spinoff. But if you were worried about that, another opportunity would be to buy 3M shares and to short out your exposure, either through puts or through just shorting the number of shares that you expect to receive of Neogen. And so there's ways to manage it. Another thing is the odd lot provision could get removed. So, it's not a guarantee that will stay in place. Usually the odd lot provisions stay in place. So, but this is kind of a cool little fun opportunity that I like. Again, you're not making thousands, but it's kind of a fun way to make some money in a little bit over a month.
Yeah. This sort of reminds me of an opportunity that I saw. I think it was 2021 or late 2020, somewhere around then. It was this ticker WSTL. I think it was Westall Industries or something. And so it was a similar thing. So if you held under 1,000, so the stock was selling for about 60 cents a share, and it was going to be it was privatizing itself at $1 a share, and the thesis was, or sort of the game plan was, if you held under 1,000 shares, you would get cash. Otherwise, you would end up becoming a private investor. And so for smaller investors like us, if you have under 1,000 shares, if you had 999 shares, you could have that at 60 cents. And when the company went private, you could get $1 for every share you own. That was a nice 67% gain. So it's sort of similar to the one you just mentioned. So that was
I love those. I think I participated in that one too. I love those. I love those situations.
Yeah. So those are the fun ones. Always fun to keep an eye out for these. One more thing that one more investment idea. So that was one of your biggest winners was Thungela Resources. So how did you find that stock, and how did that play out?
Yeah, so Thungela Resources was basically a South African coal company that was spun out of Anglo American, so a big diversified mining company. Nobody wants coal exposure, right? Everybody wants to be ESG. Coal is not environmentally friendly. It's the dirtiest of the fossil fuels. But a lot of countries, especially emerging countries, still use coal because it's the cheapest. It's very, very cheap and plentiful. And so usually you ask me about kind of what I look for, and I usually don't. Generally, it's not a good idea, stating the obvious, but to invest in companies that are in secular decline. Like usually you don't want to invest in a coal company or something similar to that.
Like a radio company or something like that. Yeah.
Exactly. Like, especially if they have a lot of debt. I mean, because the debt can just be crippling, right? But the cool thing about this was, first of all, it was a Anglo-American, was a massive multi-cap company spinning off this tiny little South African coal company. Nobody wanted a pure play coal company. And so there was a big difference between the market cap of the parent and the market cap of the spinoff. And so that often leads to indiscriminate selling pressure, because a large cap portfolio manager that's focused on large cap stocks, by definition, by mandate, can't own a small cap stock. And so that just keeps the indiscriminate selling pressure really going. So the interesting thing here was that this company had no debt. It had net cash on the balance sheet. And then the other crazy thing, and this wasn't really evident until the stock started trading on its own, but coal prices just started absolutely going crazy. So they historically had averaged the type of coal that Thungela was selling. They'd averaged it had vacillated between, call it, $50 a ton and $100 a ton. At the time of the spinoff, it was like 120, but then it kept trending up and was up to 200 and 300. And with Thungela's business model, where it's a very high fixed cost, all that additional pricing, there's tons of operating leverage. And so all that revenue and cash was going to flow through to the bottom line. And so I'm not by any means a commodity expert or a mining expert or a very good modeler of commodity companies, but it really was very simplistic. You could create a very basic model and figure out that at the current price, Thungela was basically trading at 1x free cash flow. And so no matter what it is, and especially if you don't have any debt, like, that is good. That's what you want to buy companies at 1x free cash flow, even if it's a commodity company. And then the other thing that just got me really, really bulled up, really fired up, was that they had a dividend policy that they said, hey, we're going to pay out, I think it was, I'm blanking on it right now, but it was something like 50% of excess cash we're going to pay out. And so they were basically telling you that, because oftentimes, you invest in a company that's cheap, but the problem with being a public market investor is you never know when you're going to get access to that cash, right? They could make a stupid acquisition. They could diversify into making EV cars or lithium mines, whatever is the cool thing to invest in these days. But the management team was just focused on sticking with coal, and they said, hey, we're going to invest in our business, but the majority of the cash that comes out, we're just going to pay out as dividends. And so that got me really excited. And so that's kind of it in a nutshell. Unfortunately, we were up, about 100%, but I sold too early. I got spooked out by the volatility, and the stock's up like 500 or 600%, I think, since when I originally recommended it. Unfortunately, I only got in for about 100% of the upside. The thing that's just tricky about commodity companies is they're terrible business models. And so at least in my opinion, it's hard to know exactly when to sell, because I don't know what the price of coal is going to be next year. I have my view, but I don't have a ton of confidence in it. And so that was the hard thing about Thungela. But yeah, that was a fun one. I try to monitor all spinoffs that are going on. I'm not as close to international spinoffs. So if anybody finds an international spinoff that looks interesting, and I think actually somebody on Twitter flagged Thungela, and Twitter is a huge resource for me. And so I put it on my watch list. And once I dug in, I was able to run the basic numbers, figure out it looked extraordinarily cheap, and that they were going to be paying this big dividend. And so that's how I found that one. But yeah, that one, when I found that one and actually understood the earnings power of the business, it's like a drop everything, no brainer, dive in and buy a whole lot of the stock. But unfortunately, those don't come around that often. And then, of course, we've talked about a lot of names that have done well, but of course, like everybody, I've had my losers as well.
And so with Thungela, what was interesting was it had no debt and it was crazy cheap. So in a way, usually the thing that we were discussing earlier was if it's a secular declining company, in a declining industry, say in a radio, or here it's in coal, and you're seeing the shift to ESG. Debt can be a big problem, and companies like radio companies are usually saddled with a lot of debt, and it was just interesting that companies like Thungela had no debt while it was generating a lot of free cash flow every single month. So
exactly. That's exactly right. Yeah. I've I grew up as a value investor, and because my dad was a value investor, and so kind of I was really focused on buying low price to cash flow, low price to earning stocks. And I still think that's a good method, but I've just been scarred because it's not, generally growth is better than no growth. And so, the great thing about microcaps is that you can find companies that are trading at value multiples, even though they're growing. In the case of Thungela, you're exactly right why I thought it was so attractive. It was a commodity company, not a great business model, but no debt. So your downside's limited. Plus they had a lot of cash on the balance sheet. So
exactly.
even if it traded down to cash, it was like a 50% decline, right? But then it's generating 1x free cash flow. So say that goes to 2x or 3x. That's not a heroic assumption. You make a really nice return. And then the third factor was just the dividend. The fact that they had stated we're going to pay it out, right? And so that gave me confidence that once more people knew that, then they would get equally as excited as I was.
Yeah. And in a way, you sort of had the margin of safety for putting your capital in South Africa, which obviously has more political risk compared to the US, as well as the fact that it was a commodity company. And do you think it was also helped by the fact that over the last, say, 24 months, we've sort of seen some sort of a bull market in commodities and in energy? So, do you think that was a factor as well?
100%. I mean, that was the factor. I mean, that was the factor why it just went crazy. And I got lucky from that perspective. But I mean, I didn't bank on coal going at $200 a ton or $300 a ton. It was just like, if you just looked at the current price of coal and you didn't, I wasn't even really projecting the future, but I was just thinking, hey, if it stays at the current price, this thing is generating its market cap in cash every year. And then the story just got better and better as coal prices just got higher and higher.
Mm-hmm. Got it. Yeah. Okay, so let's move on to talking about more general topics as it relates to spin-off investing. So, why do you focus on spin-offs as opposed to other special situations? You sort of described earlier that special situations broadly have that idiosyncratic alpha that you can generate. So, what drove you to spin-offs as opposed to other special situations, and why do you focus on them?
Yeah, you know what? I think it was just I read Joel Greenblatt's book, and You Can Be a Stock Market Genius, and he just describes it, and it's like the light bulb moment. I mean, I know a lot of other investors have read that book, and you read this. He describes it as, hey, the S&P 500 has generated 10% returns. Spinoffs on average have beat the market by 10%. So if you just pick an average spinoff, you can generate 20% returns per year. But if you pick the better ones, you can generate maybe 30% a year. And as it turns out, it's not that easy. A lot of people read that book, and a lot of people are looking at spinoffs. So it's not maybe as inefficient market as it has been before. But that's what got me, super interested in. It was the first special situation, I guess, that I've learned about. And so that's why I was so excited about it, because it just made so much sense. But then as I've read more and more about spinoffs, I've been more tuned to other types of special situations, and I'm getting more experience with other special situations, like liquidations, or one thing that I've noticed. It's just, as you probably do, you notice certain things and certain trends in the market, and you kind of dig into them and dive into them and see if there's any academic papers written about them, and see if this is an anomaly that has been documented before. Like, one thing that I've noticed is that companies that talk about a company, especially if it's a small cap company, can say, hey, we have this big windfall, we're going to pay a special dividend. But if they haven't declared it yet, once the declaration actually comes, the stock price will jump. Even though that's not rational, like that's not any new news, but for some reason, the data that I've looked at, and the stocks that I've looked at have shown me that like the stocks jump after the special dividend is confirmed. And so that's like another kind of special situation that I'm added to my repertoire that I've learned about. I've noticed a similar thing with division sales. So oftentimes a company will sell a division, and there will be people will be like, okay, that sounds good. You're going to sell this division. But on the day that the division closes, the sale closes, like there's a big stock market reaction, even if the management team on every call leading up to the closing of the transaction has reiterated that this transaction is going to close. I've noticed a little bit of an anomaly there. And so I'm always trying to keep track of new special situations to monitor. But I think I focused on spinoffs just because the thesis just made so much sense, and I've had success in it, right? So I've been able to find some of these really attractive situations, and I've learned a lot over time. But I'm not by any means focused just on spinoffs. I like to look anywhere, and I'm really open to any idea that looks interesting.
Uh-huh. Yeah. Yeah. And when it comes to the opportunity set in spin-off, so one, do you notice that it's mostly concentrated around, say, US small cap, micro caps, and two, now let's say, over time, so let's say, from 20 years ago to today, do you think the number of special situations and spin-off opportunities has come down, or do you think they still happen all the time?
Yeah, so I think in terms of how many happen, so I think it's kind of cyclical. So what happens is when there's a lot will be announced, especially when the market's kind of going up, because management team has time. There are no crises to have to deal with, and so the management teams are saying, "Hey, how can I increase value?" Usually Wall Street and investors prefer simplicity. So if you're a big conglomerate, one way to increase value is to break your company up into its individual parts. That usually is a good formula for unlocking value, not always, but generally. And so generally when the market's doing well, the economy's pretty good, there are no fires to put out, more companies think about doing spinoffs. And then once a crisis hits, like the pandemic, when the market dropped by 20 or 30% in about a month, then there's like no spinoff activities because no new spinoffs announced, and the spinoffs that are announced get pushed out a little bit. And the reason is simple: people are just trying to figure out how to keep their businesses going, keep the lights on. And so it is a little cyclical. In terms of the number of spinoffs, they're usually about 20 or 30 in the US per year, and that hasn't varied a ton year over year. There aren't as many when we're in a recession or when there's a pandemic or something like that, but generally it'll come back. It'll come back with the market. And then in terms of special situations, whether there are more now than there have been before, I mean, I don't know about that, but one thing that is cool is that there are just so many. It's way easier, I would say, to find interesting ideas to invest in, whether it's on Twitter, like I'm on Twitter, I'm a big fan of Twitter, whether it's ideas that subscribers to my newsletter are sending me, whether it's manager letters. There's a lot of great managers out there who share their ideas after they've published, they've gotten a full exposure to an idea. And then you can use simple things like Google Alerts, which is what I use to monitor some special situations. So I don't know if there's more, but it definitely feels like it, because I just think there's so many almost sources of ideas. And that I'm not even really talking about international either. And that's a whole nother world as well. I'm primarily focused on the US just because I'm finding good opportunities there, but I'm also very open to international ideas as well.
Got it. Yeah, and Twitter is fantastic for one tracking ideas too. You're also likely to find some bears on the ideas that you're bullish on, and that sort of allows that kind of interaction where you can sort of discuss and figure out where what are the flaws and what are the risks in your thesis. So that's I find that to be like a big plus or a big positive point when it comes to Twitter.
100%. Yeah, no, totally. And then one other thing was Seeking Alpha. So Seeking Alpha is, I think, very helpful for the same reasons, in that so some of the articles are good, some of them aren't good on Seeking Alpha, but a lot of times there'll be really good comments below from very smart investors, just pointing out something that the author missed or that is underappreciated or overappreciated. So I find the same thing with Twitter, but also the Seeking Alpha comments.
Yeah. When it comes to special situations, do you ever see when it comes to special situations, do you ever see the existence of what you could broadly term activist investing, where some parties gain or some parties purchase a large part of the stock of a company and then try and influence management decisions? So do you ever see that sort of opportunity come up? And are those really opportunities or not really?
Yeah, so really good question. Definitely. So activist investing kind of goes hand in hand with spinoffs. Oftentimes, an activist investor like Elliot will establish a big position in the stock and then go public with their presentation, and say, hey, you need to break up in order to create shareholder value. There's a lot. I mean, there are obviously a lot of hedge funds that do this. Third Point, Dan Loeb also does that. He was the one who was behind Prudential spinoff of their U.S. annuity-based insurance company, Jackson Financial, and so that is a big focus for sure. I would say, or that creates a lot of spinoff opportunity. I haven't run the numbers, but I prefer when a management team comes to that decision themselves, because I guess it's a little bit less biased when they're saying, hey, like, we see this value. We don't think the market is fully appreciating it. We're going to take steps to actually create shareholder value. And so I think I prefer when a management team comes to it from their own perspective, or because they want to. Yeah, exactly. But I look at all spinoffs, right? And so I think any spinoff is interesting. Oftentimes the activist investor wants to own the parent company. They want the parent to spin off the small subsidiary because it's holding the multiple down of the parent company. And so they're maybe not as interested in the small cap, micro cap. And that's really kind of where I'm interested in. And so once that spinoff happens, hopefully it's a good business that I would want to own. That's number one. And then number two, hopefully it gets sold indiscriminately, and we get a chance to buy it at an attractive price.
Yep, absolutely. One thing that we've seen is, a lot of people make the case that micro caps and small caps are usually better in terms of searching for alpha, simply because the big hedge funds that that obviously have some of the smartest people in finance, and they can't really go and they can't really go hunting in micro caps, simply because the capital that they have to deploy is so large. And what we've actually seen over the last few years, or the last 24 months, say, from the start of COVID to now, has been this proliferation in the number of these small cap or micro cap value funds. And so have you ever has that had an impact on the number of opportunities, the fact that there have been a lot of these micro cap investment funds set up? Or do you think the micro cap space is still just as good as it was say a couple of years back?
You know what? I wasn't aware that there are more micro cap funds today than there were a couple of years ago. That's really interesting. So I don't know. I think the good news is there are just so many micro caps, right? Like, I think there are 10,000 in the US and Canada that are investable stocks, and there's just so many. And so if you can't find a good, maybe it definitely does make it more competitive. But if you can't find an idea looking at 10,000 different stocks, like, maybe that's on you, maybe that's not because of the competition. And then the good news is, and Greenblatt talks about this, is that the good microcap investors will have to move upstream. So if they're really good, they're going to generate really good returns, and they're going to increase their assets, and they're going to have to invest in bigger ideas. So one example of this is Connor Haley. He runs AltaFox Capital. Do you know Connor?
Yeah, he's fantastic.
So
I was following his activist investment in CLCT a while back, so it's very cool.
So super smart investor, and a great team. Like, I know he has some really smart analysts as well, and they kill it. Like, I think even though everybody's gotten pulled back a little bit. Like I think they've generated 40% net returns since inception. I think they've launched like 4 years ago. So, and that's like with the big drawdown in the market right now. So some pretty spectacular returns, but people want to give him more money. And I would be surprised if within a few years he wasn't managing over $1 billion, right? And so when you invest, you just can't really invest in under 100 million market cap companies when you're managing over $1 billion. And so I think that also helps you, that the best microcap investors, like, Warren Buffett started investing in microcaps. I think Seas was a microcap when he was initially investing. Peter Lynch loved to invest in microcaps, right? And I think he still even bought them when he was managing his big fund. He couldn't buy that much of them. But all these investors, Greenblatt used to invest in microcaps, but then he became famous as an investor, got rich, and decided that he would prefer to invest in more high quality, lower volatility stocks. And so I think there's always going to be opportunity, but I'm sure it's getting more competitive as these new funds launch. But I think if you're willing to do the work yourself, there's just so many ideas. There's just so many ideas out there that I don't think you have an excuse to be like, oh, the market, it's too hard now because all these other funds have launched. But it's a good point.
Yeah. Yep. Richard, anything else that you wanted to mention before we wrap up?
No. I really enjoyed this conversation. It's always fun to talk microcaps and spinoffs. So shout out to Soren who introduced us, but really appreciate you having me on. And
awesome.
hope to stay in touch.
Yep. And for anyone listening, be sure to check out stockspinoffinvesting.com if you want to learn more about spinoffs. A lot of the blog posts, I think all the blog posts are free, and it's very interesting to read, especially like your older opportunities and sort of seeing how they've played out. So
yeah, and then if anybody has any questions, feel free to shoot me an email at rich@stockspinoffinvesting.com, or I'm at Twitter at Stock Spinoffs. If you just search Rich Howe Twitter, that should pop up too. But love talking with other investors and exchanging ideas. So look forward to connecting with anybody who's interested.
Yep. Cheers. Thank you so much for being on, Rich.
Okay, thanks, Ree. This was fun.